Hi everyone, in this video I'm going to go over an example with you in Excel that will show you how you can make sound financial decisions with respect to projects that give you the option to wait to make the investment. So to understand this, let's go straight into the example. So suppose your company is deciding whether to invest in a new machine, and the new machine will increase cash flows by $330,000 per year. Okay, this is not profit, this is cash flows, which is net of capital expenditures, net of working capital, all of that. Now, you believe that the technology used in the machine has a 10-year life. What that means is that no matter when you purchase the machine, it will be obsolete 10 years from today. So this is important. Even though you have the option to wait to make the investment in the machine, the technology used in the machine is going to be obsolete in 10 years from today. So if you start the project 1 year from now, this means that you'll only be able to use the machine for 9 years. If you start the project 2 years from now, you have the option to wait to do the investment, but then you'll only be able to use the machine for 8 years because the total useful life of the technology is 10. Now it further says that the cost of the machine will decline by $120,000 per year. So this is important as well. You might be wondering, well, why would I want to wait to make the investment if I will have less and less time to use the technology? Well, because the trade-off is that every year the technology is getting cheaper. It's kind of like investing in the latest iPhone. We know that in a few years the technology will be obsolete and it will be replaced by a new iPhone. On the other hand, the newest iPhone costs a whole lot, and so we're debating whether we want to delay the investment or not. Anyway, the cost of the machine will decline by $120,000 per year until it reaches $1.25 million. The question is, if your required rate of return is 12%, should you purchase the machine? And then, if so, when is the right time to make that investment? So what I'm doing here is that I've written down all the inputs that are provided to us. We are told that the initial investment, if we do it today, is going to cost us $1.85 million. The useful life of the technology is 10 years. The yearly decline in the initial investment that we will need to make is $120,000. And whenever we do the investment, the cash flows that we will get on a yearly basis is $330,000, and the discount rate is 12%. What I want to do is that I want to figure out what the NPV of this investment is going to be at different points in time. In other words, if I make the investment today versus if I make it the next year versus if I make it the year after that. That's the first thing. And understand that the trade-off is that if I delay the investment, the benefit is that the initial investment that I will need to make will be less because the cost would have declined by $120,000. However, I will only be able to get cash flows for one less year. So let's do this. So let's suppose that I have a table here which shows the different years in which I can make the investments. Year 0 represents today. So if I make the investment today, what is the capital expenditure that I will need to make? Well, that will be the 1.85. I'm going to lock this in. And we know that if I delay the investment by 1 year, then next year, the amount of investment that I will need to make will be this minus the $120,000 decline that is going to happen. So next year, the investment will cost less. I'm going to copy this formula and paste it through and through. So each year, my initial investment required will be less until it reaches $1.25 million, which is right here. It's given. So this is the lowest that it will get. Now, the question is, what is the net present value of the project at these different points in time? So what I'm going to do is that I'm going to use the present value function because it allows me to calculate the present value of an annuity. Notice that in this case, I will have an annuity because my cash flows are constant for a certain number of time period. My discount rate is 12%, and the number of time periods. Now I'm going to write this as equal to 10, which is the useful life of the technology, but I'm going to subtract the number of time periods that have gone by since today. Now, of course, it doesn't matter if I'm making the investment today because I'll be subtracting 0, but the benefit of this is that as I'll copy this formula for, say, next year, it will automatically adjust this number to, say, 9, which captures the idea that as I will delay the investment, I will have one less year to generate these cash flows. After that, I'm going to enter the payment amount, which of course is $330,000. I'm going to enter that as a negative so that my present value comes out as a positive number. And finally, from that, I'm going to subtract the initial investment that is required in this year, which is 1.85. And so if I do this, I get 14,573.60. Now, if I copy this formula and paste it through and through, these are the NPVs. Now, here is the important thing. Notice that this 14,573.6 is not directly comparable with this 28. For that matter, even this 28,000 is not directly comparable with this 29. Why? Because technically, you are calculating this NPV at the end of year 1. You're like, if I start the project at the end of year 1, what will be the worth or the net present value of the investment at that time? Whereas this is the NPV at time period 0. This is the NPV at time period 2, 3, 4, 5. And basic time value of money concept tells us that you can never, ever, ever compare numbers that are occurring at different points in time. What you need to do is that you need to discount these numbers back to time period 0 in order to compare them with this 14,573. And so that is why I'm calling this column NPV at time period T, which depicts the idea that these are NPVs at time period 0, 1, 2, 3, 4, 5, but we want NPVs at time period 0 for all of these. So what we want to do, and this is the next step, is that we're going to say equal to this guy divided by 1 plus the discount rate, and then I'm going to raise it to the power the number of time periods, which in this case is 0. The main idea here is that I want to discount each NPV back to time period 0. If we are at time period 1, then I'll be raising this to the power 1 because I need to discount this number back 1 year. Similarly, I want to discount 29,321 back 2 years, and through this formula, I will basically be doing that. So now if I press enter, obviously it has no impact on this number, but now if I automatically fill this up, notice that I'm discounting this number back 1 year, this number back 2 years, so on and so forth. In order to make a decision, you need to see where you are going to get the highest NPV in this column. And as you can see, the highest NPV is coming about at 25,287, which is 1 year from now. So now, to answer the question, should you purchase this machine? Yes, because the NPV is positive when you want to make the investment. And when is it that you want to make the investment? 1 year from now, because that is when you're getting the highest net present value, even after accounting for the fact that you will be delaying your investment by 1 year. And so this is how you can account for an option to wait in your decision making. If you found this video useful, click the like button and subscribe to the channel. And feel free to ask any questions using the comment section. Happy learning.